I just added 200 shares of Palantir to my initial stock and options exposure. I know what the criticism is. Palantir is trading at around 80 times forward price to earnings. If management misses consensus by only a penny, the stock might drop 20%. One may ask, why am I adding to my position currently? And the answer is simple. We can see that revenue is increasing drastically, and at the same time profit margins are exploding. This is something that almost no other company does currently. In Q1, Palantir generated $1.6 billion in total revenue, up 85% year over year. US revenue grew 104%, driven by a staggering 133% explosion in US commercial revenue, up to almost $600 million. This isn't just AI hype or pilot programs. Palantir closed over 200 deals worth at least $1 million in a single quarter, which includes 47 deals over $10 million. AIP is officially monetizing at scale. Hypergrowth means nothing if you burn cash in order to get it. Palantir is doing the exact opposite of that though. Look at the margin. Palantir's operating margin went from negative 8.5% in 2022 to just under 11% in 2024, and it hit 38% over the last 12 months. In Q1 alone, adjusted operating margin reached 60%, which generated almost $900 million of operating cash flow in 3 months. Palantir is now sitting on $1 billion in cash with zero debt, and every single new dollar of AIP revenue drops straight to the bottom line. Palantir trades at around 80 times forward earnings, and analyst consensus projects EPS to grow 97% this year alone, 42% in 2027, 44% in 2028, compressing the PE down from 80 to about 25 by 2029. Using this consensus estimate of almost $5 of EPS in 2029, let's look at what happens on the different multiples. At 20 times earnings, Palantir is worth 99 per share. Not cool. At 25 times earnings, the stock is worth 124, which means I will be at a 0% return from today's price level. To hit 174 or higher, Palantir must remain a premium multiple of 35 or more. Even if Palantir meets those massive high growth targets, multiple compression could flatten stock returns if you pay too much of a price today. So I am adding 200 shares to my position because I believe that Wall Street consensus is still underestimating why enterprises choose Palantir. As Alex Karp recently put it on CNBC, enterprise customers are getting exhausted from paying for tokens that create no value by themselves. Standard LLMs give you probabilistic text, but companies don't want raw tokens or disposable scripts. What they want is something deterministic, software that can seamlessly integrate into core workflows. We also had the CTO, Mr. Sankar, pointing out, more tokens means more slop. While big tech promotes token maxing, Palantir's ontology connects AI directly to the operating system, so that it produces real and measurable financial outcomes. If Palantir continues locking in enterprise workflows and compounding annual revenue for commercial above 100%, then 2029 earnings won't just hit the analysts' targets, they will shatter them. I am betting that the underlying fundamental growth will outrun the high expectations that is already baked into the stock.